Welcome back to the channel, guys. I wanted to do a video on something called the 4% rule. Some of you may have heard of it. Some of you may be familiar with it. It's basically something we're going to talk about is, has the landscape of that 4% rule changed based on the different investments available to retail investors, particularly the income slant? We'll dive into all of this in this video and see whether the 4% rule still applies in the modern age. A lot of people backtest it against some of the older downturns or corrections or bear markets. I want to apply it to some modern ones. You will see videos out there that suggest the 4% rule potentially is on the safer end of the spectrum, but let's dig into the video today. The baseline definition of the 4%, so the safe withdrawal rate concept, which is that a retiree can withdraw 4% of their initial portfolio value in year one and adjust that dollar-pound amount annually for inflation with a 95% plus probability of not running out of money over a 30-year retirement. So it assumed a 60-40 stock bond split. Its origins was Bengen 1994 and famously the Trinity study in 1998. So if we look at this from a 21st century stress test perspective, the 4% rule is often criticized for being based on 20th century data, but how did it handle the twin disasters of the modern era? The Dotcom Bubble in 2000s and the global financial crisis in 2008. Surprisingly, the 2008 retirees, despite seeing their portfolios halved almost immediately, survived due to the massive bull market that ultimately followed. The 2000 retirees, however, faced the lost decade, as it was often referred to, where negative returns persisted for years, drained the principal dangerously low. So, sequence, risk, reality. A crash at the start of 2008 is survivable if a recovery follows. A long stagnation is the true portfolio killer. And so if we dig into the most recent one to memory, which is the pandemic, it didn't break the rules. In March 2020, markets plummeted nearly 34% for a retiree. This looked like the end. However, the recovery was V-shaped and rapid, fueled by unprecedented fiscal stimulus. So what you've got to realize is a lot of the governments around the world were trying to keep everything afloat, and so they were literally pumping money into the economy. No one could do anything with that money because they were all sitting at home doing nothing. And so what did they do? They put it into the markets. There were a lot of new brokerage accounts. If you look at Robinhood's growth on accounts, there was a lot of growth during the pandemic period, and similarly for Trading 212 here in UK and Europe. Because the drawdown lasted only a few months, not years, the regular 4% withdrawals did not have time to cannibalize a significant portion of the shares at the rock bottom prices. So duration matters more than depth. So inflation in 2021 to 2023 posed a bigger threat than the crash itself. So it's almost trying to achieve a balance. So there's no single asset class is perfect. The S&P 500 offers growth but high volatility, income products over yield but capped upside. But by blending those assets, we can create a diversified portfolio that scores well in typically all metrics. And I want to take a look at this with this visualization. So if we were to look at just the S&P 500, pure equity, excellent growth potential, can be tax efficient, but yields are very low without selling shares, creating a sequence of return risk. And I just released a video how, with these growth stocks, it's really hard to time the top and the bottom and knowing when to sell, and you could end up selling at a really bad time. And this is something I personally always struggled with when it came to growth investing. We've then got a fairly more modern concept now available to retail investors in the form of these massive yields that solve the cash flow problem because they cap your upside during bull markets. And yes, they can be slightly tax inefficient if not held in a tax wrapper, but then you are getting some lower volatility and you're getting some inflation protection and you are getting a little bit of growth. But at least you're almost selling as it's going up. So you don't have to worry about it. It's almost like the fund is automatically doing some of that sell-off on the way up. Then real assets often hold value better. And so you've got potentially other things that fit into this category of real assets. So they could be commodities, as an example, gold, silver. You've got REITs, which are obviously another income producer as well. So depending on what's happening in the markets and what it's related to, these can work against normal market moves. Again, there is a yield, sometimes not with some of the commodities, obviously, but with some REITs. And the idea is most of the time they're fairly stable. They do have an element of growth associated to them. So that then begs the question, the sweet spot. So by combining all of these, like maybe 40% stocks, 30% income, 30% real assets, you sacrifice the maximum possible return to ensure you never face a catastrophic failure. The balance is key to that kind of 4% rule. And I think one of the takeaways for me is achieving this balance within my portfolio. Now, again, in the video that I did the other day around the growth and trying to capture the growth, I also talked about the fact that obviously in a portfolio, you need to assess your own situation and what the balance versus of growth and income are for you. For some people in retirement, as an example, they are looking for income, but more stable income. When you're younger, you might be more towards the growth side with a bit more aggressive income funds. Again, I think everyone needs a certain balance of cash and commodities in their portfolio or bonds to help with different market conditions. But I think getting the right mix is key. It's not always easy. There's a lot of funds out there that do the same kind of thing. And then it comes down to sometimes just expenses versus performance. But again, hopefully this kind of gives you an overview of why I think it's important. So the 4% rule survived the 2008 crash, but struggled in the stagnation of the 2000s. Today, investors don't have to rely on just selling shares alone. These modern income strategies can generate the 4% through yield, preserving the principal for the long haul. So there you go, guys. Hopefully you found this video useful. Again, don't treat anything as financial advice. Do your own research. It's for education purposes only. Make sure you like the video and please subscribe. A lot of you watching today haven't subscribed yet. It really helps the channel. And again, if you want to join like-minded individuals, we have a Discord. I'll put the link in the description. Please join us there. Love to know how you're planning your portfolio. And again, for those of you that want to comment as well, please drop something in the comment. I'll do my best to respond to every comment I can and get back to you as quickly as I can. Thanks a lot, guys. I'll catch you on the next one.